G'day guys, Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Be sure to check out the links below, including exchanges I use and social media content that I post. All right, let's go. So the topic for this video, we're just going over the Nikkei, so the Japanese market, just checking back in with how that's tracking today after its horrific drop yesterday. Also, it's a bit fear and greed in the stock market, the 10-year versus the 2-year yields. And we'll look at some jobs numbers like unemployment rate and the SARM rule to see if we are in a recession. Okay, so I want to check in to really pin down, is it the start of the downturn in the markets? We have to give it time, but yeah, it's looking that way surely. So I will show you these indicators and data points in this video. So first up, we had the Nikkei 225, so the Japanese stock market. And yesterday we had a boom. We had a bust. It was a 12% down day, all right? So we opened up the session around here, all right, August 5th, around there. Okay, 9:30, right? And we came all the way down there. It was a 12.5% drop. And from that point that we had here, we are basically back to it again, right back up there again. And we had a big move this session from the lows that made all the way up, back up to here again. So as you see today, we're up 10.23%. Starting from down here, of course, and we're back up here, and everything looks back to normal again. It was just like a blimp, just like a dip, and then it got really heavily bought, this big V shape, and then boom, back up again. So the big traders are playing games. The big banks are definitely having a bit of fun there with the mass panic that occurred yesterday, and now they've taken advantage of it and they've driven it back up. So that was very, very interesting. You can see in the futures market in the US, it's about to open up tonight, later on. But we had the Dow up 0.67%. We have S&P futures up 1%. And the NASDAQ futures 1.5%. And you can see gold there is barely up. It's just flat. Crude oil's a little bit up. But yeah, that's the futures looking like at the moment. So they're all looking positive and recovering from yesterday's ugly session. But yeah, you can see it was a down day yesterday. That was the results for the close of the indexes, and now we're seeing them back up positive again. So it's all across all markets. Okay, so that's what's really going on, and that's for the Nifty 50, the HSI, the Sensex, and the SSE, if you know what those markets are. And we haven't seen these open up yet. But yeah, the futures for the US is what we got here, and it's looking very, very green. So the fear and greed index from, especially yesterday's reading, we got 16. So we're in extreme fear. Nasty, nasty, nasty. Really, really bad. And if you go on a timeline and have a look specifically where we're tracking. So we had April, we had the dip, had the big sort of correction there, the stock market. And we're there, from mid-April to early May. We came out of it. It's like, oh, we're out of this fear. We're going up. We're going to the races from here. And then, no, we traded back down slightly. Had one push up, ungasped. That was the top of the market, right, mid-July. And then we've had a sell-off, okay? And now, look at that, 16. Wow. So we're back to even below these levels, okay? You have to go back even further, the timeline. So it's looking pretty nasty there in the timeline there. So it goes back even further. I can't really go back, I don't think. No, I can't go back. So it goes below the October correction. So is it August? So basically this time last year we had a correction in the summer for America. So yeah, pretty downwards from last year, and we're sort of tracking that momentum this year as well. From starting from August and tracking down. Starting from August and tracking down. Okay, so yeah, very very nasty agreed fear index showing there. So just want to go over the yields, the Treasury market, which is definitely the bond market does signal what's going to come ahead. It gives you an idea of roughly. It doesn't give you exact time, but it gives you an understanding of where we're heading in terms of recessionary fears. Okay, so we've been inverted for a long time. So from July, start of July to now, this is over 2 years of inversion. So it's been underneath this zero line, this black line. So it's the 10-year minus the 2-year. It's the sort of spread there between the two and the differences between the yields. So the 10-year has been paying less of a yield than the 2-year. 2-year has been paying a higher yield. So the short-term bonds are paying higher term yields, coupons than the 10-year. Okay, and if you look at the other yields, like the 30-year, the 20-year, and all the other ones, you compare the short-term bonds, and they're all less yielding. It should be higher yielding because you're holding them for a higher period, which is quite normal. As you see in these periods, it's quite normal to see it above this line. But as you see, when it inverts there, and then uninverts, we've got a recession, right? I could take you back even further to really show you what's going on. And I will zoom in a bit better so you can see it. And every time, we invert, okay, and then recession was earlier before we uninverted. Did get an earlier recession more indication before it actually uninverted, and it just went parabolic, right? As you can see there, and went back down again. So it inverted again, and then uninverted, and we had a recession again. So back-to-back recessions there, very very choppy. We inverted, uninverted. You got the 1990 recession. We inverted, uninverted. We had a recession here, 2000, the dot-com bubble. We actually did invert here and uninvert, but it was a fake out for some reason. That was the odd, surprise. It didn't actually. It was very quick. It was boom, boom. You want it to stay under for a bit of time to really confirm it. This one was the same. We did invert, uninvert. Okay, and 2020 was a recession, but it was very, very much like the 1998 one. It was just dipped a little slightly and then bang, right back up. And obviously 2008 was one, and now with 2 years, and now we're sort of starting to uninvert. We actually did uninvert yesterday. Okay, we actually did. It's not showing on this chart here, but we actually, for a very brief period of time, we did uninvert. So I'll show you that now. So a 10-year, so we're at 3.86 at the moment, right? And the 2-year is at 3.98. So it's still inverted. So 2 years paying higher than the 10-year, as you can see. But yesterday's session, so if I go back 5 days, right, the very top here, where are we? A day ago. We have to go, so 3.87, right? Roughly, we got to. And let's have a quick look at this one. So, yeah, where was it? So yesterday was the 5th of August. Okay, so 3.65, right? And then you go to this one and 3.67. See that? So it's paying a higher yield than the 2-year. That's what I'm trying to point out is this dip here. So not the high, the bottom. As you can see here, I just sort of tried to work it out. You can see down the bottom here, it's 3.66 or 66 or 67. Depending on how you read it, right? The very lowest point from yesterday. And here it was 3.65. So less than the 10-year yield. So it's paying less, inverted, okay? Technically, just for this very snapshot of time, it inverted. It's like 5, 10 minutes, 15 minutes, it inverted. And back at uninverted, sorry. And then now it's inverted again, okay? So, yeah, it's just about to come out of this inversion, which has been for 2 years now. So, interesting to see if it does break back to the downside, okay, and just smash right through this level at a faster pace than the 10-year does, okay, fast pace that declines because we've been declining. You know, we're going down. 3 month, you got the 6 month, again going down, same as a 2-year, okay, been going down. So sharpening, you know, big sharp drop recently, but been sort of trickling down, which signals that recession is on the horizon, okay. The yields do give you a good indication of that. So they're the yields. So to show you another indicator to show the recession is potentially here, or not quite there yet. We'll see, but we have unemployment with the green. Okay, every time it sort of goes green and starts to sort of make a base and round up, we're above 4%. So a big reading from 4.1 to 4.3 just recently. So you go from red, right, all the way red to green, you get a recession. And the red there, recessions. You go from red to green, you get a recession. That's 2008 one, and it just takes off, just goes crazy. This one here wasn't as bad, but you go from red, as you can see, the red ribbon, to green, recession. You go from red, as you can follow here, right, green, recession, right, just after that. Not long after, it turns green, it goes recession. Okay, that's 1990. 1982 goes from red or flat. It was pretty much starting from here. So if you want to go back earlier, it was 1980. We went from red to green, recession. And it sort of flattened out a bit, and then went green again, and then boom, it just continued this uptrend. So we had a pause, and then bam, another recession back to back. 1980, 1981. It's 1982, so there's quite a big one there. And then we happened here again, went from red to green, recession. 1974, that was a terrible bear market. That was a 50% drop in the stock market. Horrible. And here, it had a bit of a fake out. So you had red, and you had a bit of green. So it did fake you out a bit, and then it sort of trended down. A bit of green, so it faked a bit. Okay, and then we had green. The thing with these ones is they didn't sort of didn't see it sort of durably push higher. It sort of did trade sideways, and then went down red, and then flattened out red again, and then it started to take off like this, like sharply. And I'll show you the next indicator to really signal even better. It's better at calling recessions than this is, but this is just a rough idea. Goes green, recession in 1970. Okay, red to green, recession. Red, sideways, didn't really turn green. Turned green durably, recession in 1958. And the early 50s, we had red, okay, red, and then green, and then we're already in this recession halfway through, and then boom, unemployment rate just skyrockets. And go back to late 40s, it's the same thing, okay? You can't really see that. You get the idea. That's the unemployment rate, so as it sort of tickles up, and it's definitely not sideways, like we had going back to these periods, okay, where I did say it was a false. This is sideways. This is not a durable push higher. And this one here, it's just sort of flat. See, it's flat. A little bit up, but not really. So you do get that. But as you can see now, this is not sideways. This is durable push up. Okay, and the bond market is another to look at to confirm this is not a fake out and is taking off. So that's that. Unemployment rate. We have the SARM rule, which is even better for calling recessions. Okay, so it goes back to the late 40s. So same as the unemployment rate goes back to late 40s. So we'll start here. What happened? Sideways, and this yellow line is the 0.5. Right line. Every time it goes over it triggers recession. So it goes over it, recession, 2020. All right. Goes over it here, recession in 2008, 2000. Goes over it, see that? Bang, recession. Goes over it, recession. 1981, recession, goes over it. And then 1980, goes over it, recession. Same as this one, sort of halfway through recession, but it confirmed it with the breakthrough, this 50 line, 0.5 line. And then we broke again in 1970, 1970. And then we had 1960, we had a break above, recession. This was a fake out. This one caught people off guard, but it broke above and then went down. But then, not long after that anyway, like this October 1959. And then by March, you had a recession. So it pretty much gave this earlier signal than this one did. Okay, so it took it here, but the recession came a bit later. So it technically wasn't really a false, because if you really want to count this earlier warning sign, but it did get a secondary confirmation as a follow through, a big breakout in the unemployment rate, and the SARM rule took off. Okay, so that's that. Then we have this one, 957, break, recession, 953, break, recession, and 949, break, recession. Okay, and now, where we are now is we're above it. Okay, above this 0.5 line, we're at 0.53, and we just need a nice skyrocketing line up here, and that will be a recession. Okay, not just a little blimp like we got in the late 50s, like this little blimp, and we came down. Okay, as you can see. All right, we need a durable break, and it holds up, like it just starts to go vertical. All right, it steepens. This steepens, and that's technically a recession, but yeah, it's very, very borderline. And we've got to wait for the Fed to cut rates as well, and that'll be confirmed, because they'll know that labour market's suffering, and that's why they'll have to cut rates. Okay, so that will be confirmed recession once they start cutting rates, which is going to come next month, September. It's very certainty. And yeah, I really see him doing that because of, I'll just show you. Let's bring up the CME Fed Watch tool. So the CME Fed Watch tool really predicts, gives you good sort of prediction probabilities of when they're going to cut rates. And you can see that September here, the probability of a 0.5 percentage basis point cut. So 50 basis point is 73.5% now. Okay. If you go back to this current there, okay, so you can see it here a bit better. Just gives you an understanding of what the probabilities are. And now 73.5 is prediction for a 50 basis point cut, and a smaller cut is a very small percentage of 26.5%. Okay, it makes up for that. And yeah, they're predictions of what's really going to come, and it's almost a certainty now. Okay, 50 basis point, which is a really big cut. It's not a small cut by any stance. It's a big freak out cut. So that's that. And yeah, you can see that's that. And then we have also the VIX. Yesterday's VIX reading was just an absolute monster. It was absolute huge. Like, look at this, 217%. Like, humongous. Okay, huge. This is, I think it is the third biggest in history. So we had the 2008 one. Okay, that was massive. See that how high it went. We had 2020 pandemic, and now this is the third highest. All right, in history. It only goes back this far, but since it was created, it's the third highest. All right, the VIX is really breaking out, and we had this downwards trend for quite a while from 2022, the start of the year, and we downtrended. We couldn't break this trend line, and then we'd smash through it, destroyed it. The third biggest spike in history, and it's not looking quite nice there for that one, to say the least. And I'll just show you the last chart, HYG versus the VIX, and it's the third largest drop. Okay, so for 2008, had it again here in 2020, and now So it's pretty much, it's a little bit like the inverse of the other chart that I showed you. The VIX is junk bonds, HYG, high graded junk bonds, high yield, junk bonds versus the minus the volatility. Okay, so it's the opposite. It's the biggest drop. So pretty big bad spike down there, and it's definitely signaling some panic. Will the Fed cut earlier, like in August, like this month? There's people talking about emergency meeting to take place and the Fed to cut sooner than expected, or will they just let it play out, let the drop happen? If there's a further drop in the markets, and then they'll have to come in and then save the day and fix the economy as such, because it's not looking, they're not trying to prop up the markets, look after the markets. They're just more or less, their job is to, so they've got dual mandate. The Fed have to keep prices stable as possible, so the inflation rate, and their other mandate is the labour market. So the unemployment is what they're tracking, and if it gets worse, so really like the mid to high fours, if it goes like into that sort of realm, starts to take off, then they're gonna step in and save the day with an aggressive cut. Like 50 basis points would be the base case. They could even go 75 basis point cut, or even 100 basis points, which would be just catastrophically bad. Okay, so it's just waiting on that to happen. But the stock market at the moment is, if we go to the daily, is on the futures market. It did have a bit of a rally, but we're sort of coming back down a little bit. So interesting to see if it come back down and just break lower. Okay, the panic could happen. And the Nasdaq's the same thing. We had a big shoot down and a little bit of a green up. Okay, obviously it just closed here and then sort of opened up there and gapped a bit. So interesting to see how the markets open in tonight's session, and also the crypto market tracks. Because it's had a big recovery. Like Bitcoin's had a recovery, had a big wick down. Okay, came back down to my level, 51K, and bouncing back up nicely at this channel. Okay, so resting on it right now. Just waiting for the stock market, really, tonight's session. Okay, I hope you enjoyed this video. Just going over the Nikkei again, just tracking on after its terrible drop. It dropped 12.5% yesterday, and today it's up over 10%. And I do believe, I did read a headline that it was the biggest single gain since 2008. So pretty big move since then. And we looked at the fear and greed of the stock markets. We also looked at the bond market, look at the 10-year versus 2-year yield to see if the recession is around the corner. And we did uninvert, for a very brief period of time, like 10, 15 minutes, and then it just reinverted. So the 10-year was paying more of a yield than the 2-year for 10, 15 minutes, and then it just back to where it was before. So back down in the inversion. So it hasn't durably broke out yet. So it hasn't triggered recession. Essentially, the mod market, as it's a bull steepener, as rates are, the rates are dropping, the yields are dropping, and it's only time before the Fed cuts rates, and the inflation's obviously going down. So it's showing a growth scare, a slowdown in growth and slowdown in inflation. So pretty bad. We also looked at the jobs markets, the unemployment rate, the SARM rule, and seeing the jobs market is starting to break pretty vertically up. It's formed a base, and now it's sort of starting to take off. And the SARM rule has been triggered above 0.5 level, and every time it's happened, except for one, if you can say that. But 6 months later, it did occur anyway. So if you disinclude that, it's been correct for every single recession since 1949. So very accurate indicator there for recession. And also, we looked at the CME, predictions for rate cuts, and seeing that the panic is going on at the moment with the volatility index just going absolutely parabolic, the third biggest spike in history, same as the HYG minus fixed, the third biggest drop in history. And the rate cut predictions for a 50 basis point cut is 73.5%. Okay, so by September, a little cut. But will they cut in August just as an emergency procedure if things get really bad? Will they intervene because of the markets, or they just want to wait for some more data to come out, like the inflation rate, which is next week? It's very, very crucial to look out for. And then the next jobs number. Okay. So, yeah. All right, I hope you enjoyed this video. Just want you to smash the like, comment your thoughts below, subscribe to stay updated, check out the links below. And that being said, I'll catch you next one. Cheers.